Let me begin the webinar session with by extending my appreciation to every one of you. Thank you for your time. Thank you for taking your good afternoon for joining the webinar. And first of all, please mute your mic to make sure that your mic is muted throughout the webinar to make sure that we all have a pleasant webinar session to avoid any disturbance in the background. And prior to that, let me bring you through a little bit about our disclaimer. In simple, that just to make sure that any fund name or any fund appear during the webinar session in the slide is not for marketing purposes. It's not for recommendation purposes. Please note that you will have to make sure that you view the fund prospectus, fund fact sheet, and all the relevant documents, probably by going through it with our client investment specialist prior to prior to make payment or to purchase any of the funds. Okay, as you know, today webinar we will talk about how to protect our portfolio in time of market crisis. As you know, today's market is been rather volatile. It's been dropped more than 20 to 30% in the past months, over probably end of March, and then came back up more than 10% or more than 20% over the past month. So we see it's very important to practice portfolio management, portfolio strategy that I will go through with you today. And secondly, we will go through how to construct the portfolio step by step, and I will also share our fundamental strategy in terms of constructing portfolio. I'm sorry. And then last, I will end my webinar session with a little bit of explanation in terms of why is it so important to manage our downside. People keep talking about managing downside. Some investors ask me, why not focus on the upsides? So later on, I will go through with you why is it important to manage the downside. All right, let's go on. Okay, in the field of finance management, in the field of investment, we always hear the sayings in finance that impart basic yet fundamental wisdom onto investors. There's of course the buy low, sell high. I believe you hear this a lot. And for Warren Buffett, the most fearful, be fearful when others are greedy, and be greedy when others are fearful. But there's one particular saying that doesn't get as much love from investors, I believe, which is, don't put all your eggs in one basket, right? This saying is one of the most important, saying in finance. The idea is, of course, is not to put all your life savings, all your hard-earned money into one fund or one sector or even one country, because that could be very risky, because you are exposing yourself to a very concentrated risk. If let's say that one particular sector or country happens to falter, your best egg might not survive the fall. But in today's world, I can see that some investors like the idea of doubling down with one or two holdings. Let's say buy only one or two funds. On the other hand, some investors believe it's possible to dilute your return if you over diversify. They oppose the idea of diversification in portfolio strategy. But then, of course, diversification has its limit. I wouldn't say you should buy all the funds available in our platform, or hold more than hundreds of funds in a strategy. There's a limit to that. So where is the middle ground here? Where is the fine line between investing only a particular funds or investing in a list of funds? But and how does diversification actually affects our portfolio moving forward? Okay, the portfolio strategy actually evolves around the idea of having a very well diversified portfolio across, number one is across different asset classes, which are a common one, equity funds or fixed income fund, or also known as bond funds. We also diversify the fund exposure based on geographical region. It can be segregated into different markets such as Malaysia, Asia ex-Japan market, emerging market, developed market even, and so much more. We believe diversification is one of the most important rules that one should adhere when it comes to investment. And one interesting analogy that I could not see any better representation or any better analogy that could represent portfolio diversification than a football team. I believe those football fans out there, understand this picture by a glance of it. We usually link portfolio management strategy with football team because, as you can see, you would want your portfolio to have a similar element as a football team. The defender, which is your defensive element of a portfolio, and then the midfielder and the striker or attackers should be the alpha generator element in your portfolio, whereas a goalkeeper should be the most lowest risk of all. The idea is that one is to make sure that your team covers the entire field, which in terms of portfolio, you want a portfolio that covers the whole world or the whole economy, so that whenever one side of the economy of the world is having some economic surprises or some market events that cause the economy to falter, you have the other side of the world that's supporting or maybe covering the losses that you experience on the other side. Secondly, so that you can change strategy whenever needed. You can play the common 1-4-4-2 strategy when in football game, or you can play 3-4-3. Add in more attackers whenever you think you have more chances to win the game, or in terms of investment, you think the more markets tend to reflect a more attractive valuation. So you want to add a little bit more exposure into equity fund, for example, and reduce a little bit of your bond fund, and vice versa. Whenever you think market is having a volatile trend, you will want to play a little bit defensive strategy. So you want to increase your defensive elements. You want to increase your defenders. Maybe you play 5-3-2, right? 5-4-1, for example. All right. And then the third one, you want a portfolio that you can replace the players, you can replace the funds whenever needed. You wouldn't want a fund, or let's say from a football manager side point of view, you wouldn't want to play a player which didn't score goals for the entire season, right? You want a player who is the top scorer. So if you notice a fund is constantly underperform, constantly delivering negative return over the past 5 years, for instance, you might want to consider changing the fund. You might want to consider change to a new player which is more potential, more sustainable, and so on. So portfolio strategy is very much similar to managing a football team. And then one good question, some investor ask me, why not I just put all my exposure into equity funds, 100% into equity funds without any stabilizer, without any defensive elements. I compare with this strategy. You can play all attackers into, in the other side of the field, in the attacking side of the field, but it is pretty risky, you see. You get to score goals, of course, a lot of goals, I believe, but no defenders, chances to be score is even more likelier. You have one defender, for instance, whenever your opponent attacks your only one defender, only one keeper, chances for your portfolio to be exposed to risk is much, much higher. And reversely, let's say you want to play all defenders, you just want to be defensive, you just want to be low risk, you don't want to score goals. Yes, you might probably draw the game, right? Let's say you just aim to draw the game. You don't even want to win. But then I believe in games, in football games, no one wants to draw. Everyone wants to win. So it's also unlikely for you to win by only defending, and you would also want certain attackers, certain strikers, certain alpha generator elements in your team, in your portfolio. All right. So all in all, I believe portfolio should look like this, with all the elements from attacking, midfielder or and defensive, even keeper, all in place. All right, I believe this is very straightforward for you to understand. This is our philosophy and our principle all this while. We want a portfolio with fundamentals, because we believe to investing in value market, in attractive valuation market over time, and the price of a security will automatically reflect its intrinsic value or its fair valuation over the past 3 to 5 years. Because we believe whenever the market is having any downtrend, it would take slightly longer term to recover. It wouldn't recover overnight or over 1 week or 1 month. So aim for the fair valuation and invest according to its value. And of course, make decision on fundamental analysis instead of emotion. Secondly, practice diversification. To all the time maintain a prudent diversification, predominantly buy and hold strategy instead. Tactical strategy is also important to be employed to enhance the performance, because as I mentioned earlier in the football strategy, you would want to change your player, you would want to replace your strategy and so on in order to aim for alpha generation. And product selection is the key to generate outperformance. In terms of horizon, we will encourage investor to practice longer term horizon and do not speculate the market, because we wouldn't know what will happen in the future. So by timing the bottom, or by timing the peak is pretty risky. And also do not engage in frequent trading. That's our philosophy and principles that we hold all this while. That pretty much the first session. Now let us go through the construction on how should we build a portfolio, a diversified portfolio, to protect our investment. Okay, first of all, why I put this at the first place is because it is the key fundamental, and it's the most prominent elements that I think everyone should first understand prior to invest, is to recognize your own unique risk profile. Everyone has their own risk profile. Everyone has their own, risk tolerance. So, which one is yours? So this is key to to avoid you from taking any excessive risk, by understanding how much you should allocate into equity and how much you should allocate into bonds. Usually, we will advise investors to perform a risk profile questionnaire in the website for them to understand. We will ask them questions like how much is their savings, how much is their emergency saving, and how's their dependents. How many dependents that they are currently supporting, and maybe whether their current employment is pretty stable or unstable, and so on. So from there, we will assess and let you know which category of risk that suits you the most, and we will advise portfolio recommendation and portfolio diversification accordingly. So as you can see, this is our default allocation for portfolio strategy. For balance, you can go 50-50, or you can play roughly 5 to 10% dummies. You can include 60 equity, 40 into bonds, and 70-30 for moderately aggressive, or you can go 75-35, and so on. After recognizing your own risk profile, you just have to do these 3 simple steps in order to build a well-diversified portfolio. The idea is, number one, as I said, how much you should allocate into equity or bonds, and secondly, invest according to the regional markets. These are our core markets that we usually include in our portfolios. Developed markets, emerging market, Asia ex Japan, even Malaysia market. Sub-asset type like commodities fund, sector focused fund, or country focused fund. In terms of fund selection, the final step, you may I wouldn't go in depth into fund selection, because we already have our recommended fund in our website. You can refer to the recommended fund list. We also group them into asset classes and also by market. So you can see from there for, let's say, developed markets, equity funds, which are the funds that suitable for you to choose. After these three simple steps, of course, investor will ask, by looking at the world, because you asked me to invest, in entire economy. So which part of the world that I should allocate more, and which part of the world that I should allocate less? Should I allocate equally among them? This is our guideline to determine how much allocation you should put into each of the market. MSCI World, for your information, is more of a common index for asset managers or fund managers to refer to whenever they allocate their investment, their allocation. And for us, we do things a little bit different. We refer to MSCI World GDP weighted index instead. Reason being is that MSCI World is constructed based on global views and cross-regional comparison across all market capitalization size. So it's based on the equity market size. Obviously, US would dominate because US has the one of the biggest market capitalization stock market. Whereas for MSCI World GDP Index is constructed based on weight of each country derived from the economic size instead, by referring to the GDP data rather than the size of its equity market. So over time, we think GDP data tend to have more stability, to be the benchmark, to be the guideline instead of equity market prices. Nevertheless, one more important thing, as you can see, should we construct our portfolio based on MSCI World Index, our judgment will be based on historical data instead of current data, because market prices are all historical. So it's good for us to look at the current state of the economy, the current health of the economy in the country, in a particular country, in order to construct a portfolio allocation. This weighted GDP weighted index consider one is the economy size, the economic performance, and how the country is doing right now. I give you an example. Let's look at China. On the left, China is in gray, and on the right, China is in orange. Okay, China is the second largest market in the world, but in MSCI World, China only stands about 5%. But in GDP weighted index, China stands about 19%. Okay, it doesn't really make sense for us to put only 5% into China in a portfolio, because China contribute almost 19% to the world, right? So similarly, if you follow the MSCI World Index, for sure your portfolio will highly overweight into US market. You will have majority of your exposure into US market, which pose you, excessive risk, because you are invested so heavily into one particular market. Whatever happened to US, your portfolio will definitely take a hit. So hence, we might want to align our portfolio allocation with the country GDP position, because that indicates the health of the economy. I think it's deemed as a better guideline or better representation of where the market, the market stands among the others country. So this is even our managed portfolio, we also practice the same. We refer to MSCI World GDP weighted index instead. Okay, all in all, I think our equity portfolio and our bond portfolio, according to the index, one can allocate as such: US, European, Japan for developed market, Malaysia, Asia ex Japan, and emerging market for equity portion. However, on the bond side of things, they can allocate Malaysia, both short and all duration. Reason being, we include local bond fund is the major reason is you wouldn't expose to the foreign currency exchange risk, because as you know, when you invest in foreign funds, the fund manager will convert your currency, our MYR currency, into the respective country's currency prior to invest. So by investing in local funds, you are totally eliminating the risk exposure. And for those investor with a higher risk category, higher risk profile, they will want to include some higher yield bonds. They can go for Asian bond or emerging market bond, because these bonds usually tend to deliver higher yield as compared to the local bond fund. Okay, so for a well-diversified portfolio, one portfolio should roughly look like this. As you can see, I divide into three sections: the core equity section, core fixed income section, and also supplementary. The core portfolio is invested in broadly diversified regional funds, such as those Asia Japan, Asia Pacific, global market, developed market, and so on, as I mentioned earlier. These funds usually are held for longer term, for instance, 5 years and more. We advocate this geographical diversification because usually market tends to have asymmetric return. They don't perform quite, in a uniform manner. They perform in asymmetric return, might perform differently. So as such, markets which perform better than the peers, right? Market which perform better than other markets should help to cushion or to negate the market which are lagging. So the funds which is having profit can potentially helps to reduce the loss which experienced by other funds. Whenever for supplementary section, as you can see at the bottom left, which denoted by Greater China and Malaysia small cap, these funds usually tend to have a more concentrated exposure as compared to the core equity fund, because they only invest in, for example, Greater China only in one in one region, one small region. Malaysia small cap only in Malaysia, and then even smaller scope, only the small cap market. So usually it tends to have a relatively volatile trend. These funds performance go up and down very significantly. Okay, but the key thing is this is where you make your best bets, because these country-specific, sector-specific funds, they tend to have greater volatility but bigger potential return. For example, I like to relate, investing in supplementary portfolio like eating nasi lemak ayam, for example, eating chicken nasi lemak. You can eat, the plain nasi lemak rice, egg, hard-boiled egg or fried egg, and a little bit of anchovies, cucumber slices, just a plain one. But it will be more fulfilling, it will be more attractive if you add ayam goreng, if you add fried chicken on top of it. But then, even though it is high in fulfillment, it is high in attractiveness, but over the long run, if you eat a lot of fried chicken, fried stuff, you tend to exposing your health well-being, to your health risk. So supplementary is pretty much a similar concept. It is attractive. It is very tempting to invest in these funds because they tend to deliver a high return. But then if you overexpose to these funds, they tend to cause the overall portfolio movement to be rather volatile. All right. So that's why we always advocate investor not to overexpose your supplementary section more than 20% from overall portfolio allocation, because this ensure the volatility will not affect your total portfolio return. For example, if supplementary portfolio takes up 20% of the total portfolio and your portfolio experience losses around, let's say, 30%, these 30% losses may be possible for country-specific funds. Yeah? Okay, the total of your total portfolio losses will only be around 6% from its original value. That is if you include around 20% of supplementary section. If you include more, so the losses that you will experience, that you will potentially experience, will be even higher. So on the fixed income side of things, as you can see from the 15% Asia bond and Malaysia bond, this is to go back to our main objective in diversifying. We would recommend to expand your exposure towards local bond, like I mentioned earlier, instead in terms of eliminating foreign currency exchange. Asia bond can be considered for high yield seeker. So essentially, right, one may move their equity exposure or their fixed income exposure uh, across different across asset classes. Means, let's say during financial crisis, they may want to play a bit defensive strategy and move their equity exposure from the core or from the supplementary back to fixed income to increase your fixed income allocation, and vice versa. When you see the market is having a bull run, you want to take advantage of that. You might move your fixed income allocation back to your equity. But after all, you must always adhere to the very first step that I mentioned earlier, your own risk profile. Do not, take more than what you could tolerate. Do not take unnecessary excessive risk. Try to stick to your risk profile. Try to stick to your default allocation as much as possible. Okay, and then lastly, I think that it's important to follow by regular monitoring and try to rebalance your portfolio. Let's say after 1 year or 2 year of investing, whenever you see your equity has performed rather decently, maybe make around 10 to 15% profit, and cause your overall portfolio allocation a little bit overweight towards equity, maybe 15 or 20% off track from your original allocation. So try to do some rebalancing. Try to consult our client investment specialist on how to rebalance your portfolio and move back certain profit portion to those fund that's probably is having loss at the moment, and rebalance it back to your initial allocation. Okay, okay. That conclude the second step, the construction side. Now I would like to move into why is it important to manage your downside, your portfolio downside. I will spend a little bit longer time in the third session because I think it's more important and it's more significant for your knowledge. Okay, whenever we talk about downsides, market downside, generally I will just group them into systematic and unsystematic risk, because that's the usual risk that we refer to whenever it comes to market risk. As you can see, the different markets risk, systematic and unsystematic, can be I group them into seven subtopics. Number one, meaning systematic risk tend to associated with the market or the segment as a whole, whereas for unsystematic, the hazard associated with specific security firms or industry is more focused, is more narrowly focused as compared to the systematic one. And then impact, in terms of impact, systematic risk tend to have larger impact of security in the market, and unsystematic risk, their impact is pretty restricted to the specific country or industry. And then for controllability, systematic risk can be say difficult or almost impossible to be controlled, and unsystematic risk can be controlled. In terms of hedging, how to hedge from the risk, systematic, you can allocate into different assets, and then unsystematic risk by diversification of the portfolio. In terms of types, systematics, you can see like interest risk and market risk, whereas for unsystematic risk, it's like financial and business specific risk. Responsibility factors, external, more of externally affected for systematic, and unsystematic is more of internally affected. So all this risk is a degree of uncertainty in like any stage of economy. Just like our life, in different stage of life, we tend to expose ourselves with different degree of uncertainty in terms of degree of risk. So for instance, like let's say while we are driving, or while we are on the road, there's always a risk of getting hit by a vehicle, getting involved in accidents and so on, if there's no precautionary measure being taken. Similarly, in the area of investment and finance, there are systematic and unsystematic risks. These risks are inevitable, I would say, unavoidable sometimes in any kind of financial decision. Hence, one should equip their portfolio to handle them in case of any mishap happen. It's like paying for our insurance premium. So you want to protect your life, you want to protect your dependents' life from any mishap. So by holding a well diversified portfolio is pretty much the same as having a life insurance or paying for insurance premium. Okay. As you can see, systematic risk, it does not have a specific definition, but is inherent risk existing in the stock market. These risks are usually applicable to all the sectors, but it can be controlled somehow, right? If there's an announcement or event which impact the entire stock market, for instance, a consistent reaction will flow in which a systematic risk. For example, if bonds government bond is offering a yield of around, let's say, 5% in comparison to the stock market, which offer roughly 10%, for example. And then suddenly the government announced additional tax burden, let's say 1% or 2% on stock market transaction. So this will be a systematic risk for all the stocks and make the government bond more attractive, right? So that's the example of systematic. Unsystematic is like it's more of an industry or firm specific threat, and then usually is known as specific risk and diversifiable risk. These are risks which usually existed but unplanned and occur at any point in causing widespread disruption. Okay, for example, if the staff of a company goes on indefinite strike, right? Then this will cause the risk to the share of the company to fall in the prices, and the overall stock also be impacting the industry if the weightage of the stock in the industry is huge. So this also can be caused unsystematic risk. I mean, can also be caused by increase in competition in the industry. Let's say more similar nature of business company coming to the market and cause increase in competition. And even management failure can also be among the examples of unsystematic risk. All right. So above all, the above risk can be, I would say, avoided or can be managed, can be controlled, but the impact can be limited with the help of diversification, portfolio diversification. Try to let's That's the most prominent elements that I mentioned. It's important to diversify into different sectors and different country, different regional markets to help rebalance back, to help balance the negative effects in case of any mishap in the economy. So this can be presented in an example. Let's say we have investor A and investor B, two investors, where one invests, let's say 100,000 in Malaysia small cap, Malaysia large cap, and Malaysia REITs, for example, for investor A. It seems like a portfolio which practice a certain extent of diversification, but then if you look into it, this investor only invests in Malaysia market, despite having small cap, large cap, and REITs. But in case anything happened to Malaysia, right, this investor would definitely take a hit, right? As compared to investor B, it has relatively lower risk because this portfolio exercise a very well diversified allocation into asset classes and also in terms of regional markets. So more often than not, certain fund within the portfolio will earn a positive return, while another few fund may incur losses in an extended period of time. However, the positive one might likely reduce your downside risk, or even in some of optimistic cases, they can offset your negative returns. So by splitting out our holdings, we significantly reduce our risk. But this diversification, right, it does not just mean holding a bunch of different funds. It works best when the position in your portfolio are uncorrelated. Uncorrelated, when I mean uncorrelated, is the correlation coefficient is close to 0%, right? I wouldn't go into deep into the calculation, but correlation coefficient close to 0 means the assets in your portfolio is highly uncorrelated. So let me show you a chart of how multiple markets, I would say multiple uncorrelated markets, fare in the past years. Okay, I like this chart a lot. This chart a lot because as you can see, I include emerging market, China market, Malaysia bond, S&P 500, and other indexes in like Asia bond, like our all bond index, to show you the diversification between different regional market and how they fare in the past 3 years. As you can see, the most obvious one, the pink line is denoted by S&P 500, has been outperformed the market since early 2018 until now. Okay, so uh, if you refer to the orange color line, which is China market, from 2018 until 2020, it seems like constantly underperform the rest of the markets. But certain investor will ask me, then why not I just allocate all my exposure into S&P 500, into US market? But then if you refer to the left-hand side of the chart, US 500 tend to underperform China A in 2017 rally, if you still remember. So it's fair to say diversification does not mean you allocate into one fund for forever, right? You might do rebalancing, you might do change of strategy, change of player, as I said earlier, as as we go along in our investment. If you can see the blue color and green color line, which denote by Asia ex Japan and emerging market, they tend to somehow move sideways, but then the volatility along the line, you can capture the upside potential whenever the market goes down, right? Whenever the market goes down, you exercise so-called the dollar cost averaging, buy at cheap. As the price go down, you buy progressively into the market. So when the market rebound, your portfolio tend to break even faster and to capture the most of its upside potential. So along your investment, there are a lot of strategy that you can practice. When the market go down, you practice dollar cost averaging, and the market goes up, so you enjoy as much as the potential return as possible. And then throughout 3 years, if you practice diversified portfolio, you tend to reduce your downsides by having, as you can see, the line by FSM, indices, Malaysia bond, Asia bond, and all bond. You tend to move steadily, even though there might be small drop somewhere here, but along the line it's moved pretty stable, pretty decently. It serves the purpose of protecting. It serves the purpose of stabilizing your portfolio. So I really like this chart a lot because in one picture, in one glance, it explains a lot about the importance of having a well diversified portfolio. Of course, in near term, because this is a chart between global bond and global equity over the past months during recent COVID-19 downtrend. Yes, when I say earlier we should include assets which is uncorrelated. Somehow during COVID-19 downtrend, the assets seems to be correlated, instead, because bond and stocks went down together. We think in near-term correlation between this fixed income and equity, even though has risen sharply, we do not expect it to continue to relate as such for the foreseeable future. We expect their relationship to decorrelate back to the historical level, especially once the COVID-19 situation and the dollar liquidity concerns begin to subside. So everything goes down to how fast the economy or even the world can contain COVID-19 pandemic. Then we will see these assets will decorrelate and return to its original position. But somehow this will highly depending on the response of policymaker from the government and central bank, of course. Okay, And also this chart show you at the importance of having a diversified portfolio, and also to capture the opportunity whenever there's a market downtrend. As you can see, the S&P 500 VIX index, right, which I put on the left here, is right at the top, right before COVID-19's pandemic downtrend, which is on 16th of March this year. One short month later, this VIX volatility index, S&P 500 volatility index, dropped to lower than 40, less than 40 in 16th of April. So if you follow the volatility index, like you worry too much, or your concerns is too much on the volatility index, right? At this point of time, you uh, probably will sell. You worry that the volatility index will go up and up endlessly. You probably will sell. But then you see in our recent downtrend due to COVID-19, in one short month, the volatility index dropped back to around 3-year low. As a point of talking, right? I checked a few minutes ago. Now has dropped lower than 30 in the 20 each already. So why I say is the opportunity is because if you compare the volatility index, and I put together with the S&P 500 index in purple color, in every peak, right, in every top of the volatility index serves a good point to average down your portfolio, right? Let's say, okay, look at this is 2008 financial crisis time. At the most peak, S&P 500 drop. Another peak, another drop. So also for 2011 market downtrend, 2015 oil prices crisis, 2018 during US and China trade talk, also drop a bit when the VIX peak, and 2019 also in current COVID-19 downtrend. So whenever you have even though uncorrelated diversified portfolio, right, a peak in a volatility index always serves if history is any guide. A peak in volatility index is always a good point for you to average down your portfolio. You might invest progressively, bit by bit. Don't invest all your money in one chunk. Try to split your capital. Try to split your fresh investment across maybe 5 to 6 different groups, and then invest them maybe weekly or monthly. When you see the price go down, you top up. When you see the price go down another time, you top it up again. So that will pull down your weighted average cost lower and lower, so that whenever the market rebounds, right, you tend to reach the break-even level much faster, and also capture as maximum potential upside as possible whenever the market rebounded. Okay, so all in all, another approach, let's say managing diversified portfolio is a huge hassle for you. You don't want to do such too many works in your investment. You can consider a hands-off approach, which is our managed portfolio product, because we have a portfolio manager to manage different groups of portfolio. We categorize it into 5 different risks, as I mentioned earlier. So once understand your risk profile, you can select the respective portfolio to invest in. We will do from A to Z, asset allocation, the regional market, how much allocation to invest into each of the regional markets, and what are the fund selection. We'll do it from very beginning until the end. You just invest in the portfolio that that suits you the most. A little bit of the performance. If you join our previous DPMS managed portfolio webinar, which we had recently, you might see this return as well. As you can see, our portfolios from aggressive, over to conservative, has been, I would say, rather outperformed the market, the global benchmark throughout the time frame. 1 month, 3 months, 6 months, year to date. Even though is experiencing downtrend, still it is not, and it didn't drop as much as the global benchmark. Similarly for the Islamic portfolio. Okay, and then this is an underwater chart that I put in place so that you can see better, that show you the drawdown, the maximum drawdown for each of the market and also our portfolio. As you can see in red color are our managed portfolio, conservative, and also some balance and also aggressive. You can see down here. They tend to be in the left hand side of the chart because the maximum drawdown is very, very minimum as compared to each of regional market. So comparing like our comparison between investor A and investor B just now, let's say investor A only invest in Malaysia's market and maybe some India or some US market, their portfolio will drop even more than 45%, 40%. So that is not some downside that everyone can swallow, that everyone can tolerate. Some investor might already left the market by let's say 10% drop. Some investors still can stand 15%, but different investor will have different risk tolerance. Some investor told me that they can stand 5%, they can stand 10%, but whenever the market drop just 3%, they also worry and WhatsApp me all the time already, WhatsApp me every day. So that's the thing, that's the importance, that's the prominent elements why you should always adhere your own risk profile, why you should always stick to your own risk tolerance before you invest. This is the reason. I think during the market crisis is the most obvious time where we can see whether one investor really practice a proper portfolio strategy investment or not, by looking at their reaction towards the market downturn. We can tell if we are actually investing based on our risk tolerance ability. Okay, and a short recap. First, we went through our philosophy and principles about the football team, and then we go into portfolio construction, the 3 simple steps, I hope you remember. And finally, about the comparison between indices, between volatility index along the the past few years, and why is it important, why is it always important to manage your downside and focus on reducing your risk. I like to tell my investors, my clients, that try to focus on managing your downside and let the upside do their work. Let the upside potential to reflect on its own, because whenever we manage our downside, we can have a good sleep. We can have a good time, good sleep investing, and then whatever returns that we get, try to aim for the potential, trying to aim for the attractive valuation market, and just let the potential upside reflect on its own over the long term. Don't focus too much on chasing the alpha, but then ignore to manage your downside. And whenever the hard times comes, the volatile times comes, it tends to teach you to panic and exit from the market, which again go back to our very first financial idioms, financial saying just now: buy low and sell high. Back to the trap where you buy high and you sell low. Okay, so coming to that, this is a little bit of the steps on how you can perform your risk profile questionnaire by going, after logging into your account, go to your right hand top corner, look for account update, and then go to update risk profile to answer all the questions. So when you have the result, you may speak to our client investment specialist and have them to discuss with you how you should allocate your portfolio and what are the funds that is suitable for you to include or to exclude from your portfolios. Okay, having said that, I've come to the end of my sharing today. Probably we can open around 10 to 15 minutes to the floor for some Q&A. If you have any question, you can type in the chat box, so I can answer. I can pick and choose some question to answer. Coronavirus is systematic or unsystematic? It's a systematic because it's a widespread and cause the risk to the economy as a whole. Unsystematic, as I said, is more of a focused risk into one particular sector or one particular industry. Okay, Monsiming, well sharing, not like others, only focus. Thank you so much, Monsiming. Thank you, Julia, for answering the question. How would you know when to stop dollar cost averaging down? Okay, this is a bit subjective because it depends on the particular investors on how much how much of capital that they have. For example, investor A have 1,000, investor B have 50,000 to invest with. So if you invest, let's say weekly or monthly, for normal unit trust funds, the minimum investment amount usually range from 100, to some 200. Okay, so with 1,000, you probably couldn't, keep dollar cost average down too long, as compared to those with more capital. They get to dollar cost averaging even longer, and whether the economic downtrend much longer as compared to the investor with smaller capital. So it much depending on the particular investor itself. How about Go ETF? Sorry, we do not have Go ETF in our platform, so I don't cover that at the moment. But you can email to us. We will have our research team to maybe look into it and give you some response. What's your opinion on the recent downtrend caused by COVID-19 sell-out and rapidly rebounded again? Yeah, as I explained earlier, the downtrend is unprecedented, as called by most of the articles, by most of the media news and so on. They call unprecedented economic event. But then the rapid rebound is majorly caused by investors' confidence amidst all the support from governments, from central banks, and so on, to stimulate in terms of both monetary and fiscal policies. So somehow markets tend to gain some confidence, a little bit in confidence in the market. Anyhow, the drop is way too, I would say, too significant. For example, S&P 500 dropped more than 30%, roughly 30% in that particular period of time. So that served a really huge sell-off, a really a huge bargain for value investors to capture, to get a position in such a attractive valuation. So from there, more and more people realizing the attractiveness of the market valuation and try to enter a position into it. I think, supported by the confidence that they gain from the support, the help from government and central banks, that's helped to rebound the market again. And next question, what is an acceptable return? Again, acceptable return also it depends on the investor, each particular investor, because different people aim for different range of return. Some might be comfortable with annually 5%. Some might be comfortable with slightly higher than EPF, 6 or 7%. Some high risk investor might look for between 10 to 12% a year. So I couldn't tell you what is acceptable, because that depends on yourself, how much you think is acceptable. Okay. How often or what influenced you to alter your intra-asset allocation percentage? Again, One is the attractiveness of the market, attractiveness of the valuation. So keep track. Let's say if you have the ability to, you pay close attention to the markets, pay close attention to the, the news or some research articles and so on, you might find attractiveness in this particular market at this point of time, and you have yet to have any exposure into the market. So you might want to alter accordingly. But all in all, still stick to your initial allocation according to your risk profile. Okay, I mean, Sulaiman, how often to change or reevaluate from portfolio exposure in the long term? Is there a minimum threshold? I would say not too often, because too often will lead you to the frequent trading, like I mentioned earlier. For unit trust fund, as you know, the unit fund itself is already diversified in their underlying assets. So you do not need to rebalance, or you do not need to change too often. Usually we are looking at between 3 to 5 years. If supplementary portfolio, those high risk in nature funds, maybe like 1 to 2 years to evaluate, not to hold, not to perform any re-evaluation or rebalancing too often. Would you advise people to sell and realize gains on their portfolio and sit on the sideline when there's a market downturn? Or shall we weather through every ups and downs into the okay, firstly, yes, we will advise to sit on the sideline. Well, sit on the sideline mean we will advise to stay invested whenever whenever we are weathering the market downtrend, because as I mentioned, when you stay invested, you don't stay invested and do nothing, right? You stay invested and then you average down. If you see the market is going down, you try to rebalance it. Not try to average down your weighted average cost progressively, bit by bit, and anticipate market to rebound, right? But shall we weather through every ups and down in 20 to 30 years? If you practice investment horizon up to 20 and 30 years, by all means, go ahead, because in 20 to 30 years, definitely market will go through a lot of up and downs. Some market crash, for example, happens. People say every 10 years, but that's not really the case. Some is shorter. Some is longer. Some some bull run is shorter, and then sometimes it's longer. So across your investment horizon, you get to practice dollar cost averaging. Whenever whenever you get profit, for example, after 1 or 2 year investing, try to rebalance it back. Profit in for example, in certain equity funds or certain supplementary portfolio, supplementary section of the portfolio, try to rebalance it back and put back into your those funds that is having losses. So it's not sitting on the sideline without doing anything. Try to practice dollar cost averaging, rebalancing, and so on across your investment horizon. I believe that will help a lot when you least expected it to. All right. The portfolio GDP adjusted shows US allocation at about 27%. You don't consider the valuation is among one of the highest. Okay. From the portfolio allocation, right? We usually will group US developed and developed market together, because if you refer to some global funds, they will tend to have a higher allocation into those developed market. Developed market include US, Europe, and Japan, right? Due to their bigger market capitalization size. Yeah, so 27% or 25%, roughly more. Usually, we will group it. We will allocate more than 20% to those developed market, which not limited to US. It can be adjusted across Europe or Japan whenever we think the valuation supports. We have a basis of attractive valuation into it. So it's not will always be like that. We will readjust according to the necessities. Okay. Do you put money in money market to do dollar cost averaging progressively? For information, money market is those funds which invest into different fixed deposit accounts in different financial institutions. So if your aim is to achieve somewhat similar to fixed deposit return, uh, you may consider to do so. But then I would not encourage, because money market usually deliver around 3+%. That is supposed to be your stabilizer element. It's supposed to be your complementary element with fixed income or with bond fund. So dollar cost into money market fund is a bit defeating the purpose of diversifying, because money market fund tend to have steady increase performance along the year. So practically it doesn't have much opportunity for you to dollar cost, because the return is unlikely to go down. Dollar cost averaging is more effective, it's more meaningful if you get to average it down at lower price. Probably I'll answer a few more questions. I'm retired. Okay, let's look at Gan Akia. I'm retired. How should I redeem my investment? Should I withdraw lump sum or regular withdraw as reverse or regular invest? It goes down to your retirement plan. I wouldn't advise to withdraw lump sum altogether, because as we know, we heard a lot about people you know use up all their retirement savings in a short period of time. So you may withdraw it regularly according to your need, or you might set certain timeline on your own. Let's say similar to taking salaries, you want to withdraw like every 1,500 or 2,000 or 3,000 a month, up to yourself. I don't have any specific recommendation for that. It's up to your own retirement plan. How are your Sunny Ho? How are your sales charge compared to other unit trust fund available out there? I understand robo advisory charge much lesser. Okay, let me clear the confusion here. Robo advisory, for example, I'm not sure which one you're referring to, but particularly in Malaysia, usually those portfolios invested into ETFs, into passively managed fund. As we understand, passively managed fund and as compared to actively managed fund like unit trust fund, where they have fund manager to manage their own fund. They have their fund management team to do all the research-based work, and then find the best opportunity, what the fund is supposed to invest in, as compared to fund which is passively being managed. No one really actually really like put a lot of effort into managing it. They just benchmark it with certain index, and then let the robo advisory do their work. So as compared to the difference in terms of management work, those ETF tend to charge a little bit lower sales charge, much lower charges, because they don't manage the fund. Whereas for actively managed fund, because they need to bear the cost for for transaction costs, for all the buy and sell of stocks that they perform, and also some administrative costs, some marketing costs, and so on. So it's fair to charge a little bit higher to cover the cost, as compared to some robo advisors we invest in ETFs. Okay, I believe that is the end of our session. For those questions which I didn't address, you may email to our CIS email, investhelp.my@francois.com. I believe it's my colleague mentioned in the chat room. No, yeah, okay, never mind. If you want your question to be answered, I'm sorry I couldn't answer all of them. You may email to our InvestHelp. Okay, thank you, Sean. investhelp.my@francois.com, and we will answer your question accordingly. Again, thank you so much for all of you who attend my webinar today. It's been a very great sharing, and I'll probably leave around 5 minutes for everyone to leave before I will end the session. Thank you so much, everyone.